In this video, we are going to reinforce the concepts that you learned in the previous video. On the screen, you see name of an account, and by now you should very well know what an account is. All we have to do is to identify the type of account. So we have cash written on the cash account written on the slide. So we have to figure out which type of account cash account is. Is it personal account, real account, or nominal account? Now let us, the way to do that is as follows. We identify whether cash is an asset, liability, income, or expense. And then we have the standard formula or the rule at the bottom of the slide. You have personal accounts for all the liabilities, all the assets are real account, and all expenses and incomes are nominal account. Now we very well know that cash is an asset. Cash refers to the stock of cash you have in hand, and this can be utilized towards building temporary capacity, and therefore it is also a current asset. So it's an asset and it's a current asset, but we don't have to go to the second level of categorization, the subcategory of cash, which is current asset, because we know the rule for assets. All assets are real account. So all assets are real account here. So we are using this rule and we are saying real account. Now let me repeat. The word real does not mean anything in itself. Do not refer to the English language meaning of the word real. It is just a nomenclature. Anything which is an asset will be categorized into a real account. That is it. Let's move on to another item, another account, which is bank balance. You can call it bank account, and A/C is short for account. It's again another convention that is used. I hope everybody is familiar with it because in your bank statements they do write A/C. Bank account, just like cash account is cash. So cash account is cash in hand. This is cash in the bank account. So similar, to the cash in hand. So again, this is an asset. This is a current asset as well, as we discussed earlier, and all assets are a real account. So I'm going to say a real account. Okay, so in this tutorial, this is what we're going to do. We are going to look at about 20-25 items, accounts, and we are going to identify whether they are real account, personal account, or nominal account. Let's move forward. Office equipment. Now, office equipment help you build capacity for the long run. They build capacity for the long run. What do we mean by capacity? Capacity refers to revenue generation ability or capacity. So the office equipment is going to exist for more than 1 year, and it is going to help make revenue over a long period of time, which means this is an asset clearly. And within assets, if you have to, it's kind of a revision for you. This is a fixed asset. This is a fixed tangible asset. All right. The word fixed, I'm introducing this for the first time. Fixed means something which is immovable in a way. It is used for another word for tangible assets. So tangible assets is what you already know. All right, so equipment is an asset, and we know that all assets are categorized into real account. Real account. And when we go to the next videos, it will become more clear as to why are we categorizing these accounts into personal, real, and nominals, right? There are rules using which we are going to write these transactions into the book called journal. So that's why we are learning these. Next is stock of unsold goods. Okay, so it's a stock, meaning it is with us and you have accumulated it. The purpose is you want to sell it. So the purpose is sale. However, right now it is currently it is unsold. Okay, so the intention is to sell it as soon as possible. So in less than 1 year, you want to convert it into sales. That is the idea. So anything which is going to help you generate revenue in the short run, anything which builds capacity in the short run, and I've said that building capacity refers to converting things into sale, making more money as soon as possible through revenues. Therefore, the unsold stock is also an asset. Let me write it here as well. This is an asset, and since it helps you build temporary capacity, this is a current asset. And it doesn't matter whether it is current asset or non-current asset, it is going to be real account. All assets are real account. That's the rule. Next up, you have rent for building. Now, what does this mean? Building is being used for the office purposes. Number one, that is the assumption. So let's say this is an office. This is for office use. And second, we're going to say rent is being paid, has been paid, or it is due to be paid. And according to the accrual principle, if you remember this accrual concept or accrual principle, we consider all the expenses during a given period of time. Does not matter whether we have paid it in cash or not, right? So accrual principle means due to be paid. For example, if financial year 2020 to 2021 starts in April, ends in March, so there are 12 months. So out of the 12 months, at the end of 2021, if you had paid for only 6 months, you are going to show total rent for 12 months because you have used the office building for the full year. Does not matter how much you have paid. So you are going to show rent for the full year because you have to match the expenses of this year, this financial year, to the incomes of this financial year. And whether or not you have paid rent, if you have used the office building, then the rent has become due to be paid, and therefore you should show this rent. Okay, so I just explained the nature of this transaction or this account. So we're going to call this rent account, and it is going to help you generate revenue in the short run. It is an expense of the business. It's an expense of the business. And also, if you want to further categorize it, this is operating expense. This is operating expense because this is for primary purposes in the business. You have to generate revenue, and for that you're using an office building. Now, all expenses and the losses are nominal accounts. So that rule is pretty clear. So nominal account, the third type of account. You can see the rule on the slide. Next up, you have electricity bills. So let me just call it electricity bills account. All the bills that you're going to pay for use of electricity, you can club all of those here. Clearly, this is also an expense item, and you can further categorize this as an operating expense. And again, the idea is that this is going to help you generate revenue in the short run, help you maintain your operations effectively in the short run. This is again an expense item, as we said, and all expenses are nominal account. All right. Next item is shareholders capital. Now, what is happening here is the shareholder is bringing money to the business. So let's say this is business and this is shareholder. This is the investor. Investor brings in money to the business. And if you remember, according to entity principle, these two are separate. Owner and business should not be mixed. They are not equal. They are not the same. So business should treat owner as, a separate entity. So if the owner is supplying this capital, this money to the business, then the business owes back to the owner. So if this money is being supplied by the shareholders to the business, let's say this is cash balance or bank balance, then in return the business owes to the shareholder. Business has a liability towards the owner of the business, and the name of the liability is capital. Shareholders capital is the name of the liability. This is the entity principle that we have discussed earlier. Now, based upon this, we can say that shareholders capital is a liability. And all liabilities, as the rule says, are personal account. So I'm going to write here personal account. Within the personal account, there are three categories as well. So the personal account can be a real personal account or a natural person account, real person account. Then we had artificial personal account, artificial person's account, and then we had a representative person account. Okay. So in this case, the shareholders capital is a representative personal account, and you could also say this is a real person that you owe to. However, we are not writing the name of the person here. We just clubbing everything under shareholders capital. So the capital account represents all the shareholders of the business. So most accurate categorization of this would be representative personal account. The account of shareholders capital account represents the claims that the shareholders have on the business. It's the liability of the business towards the shareholders. So to conclude, shareholders capital is going to be treated as a personal account because it's a liability, and that's the thumb rule to go with. Okay, next up is purchase of goods. Now, why do you purchase goods? The purpose is reselling. All right, this is important, and I'll tell you why. The goods which are purchased in the business, you do not intend to keep them with you for more than 1 year. The idea is to, as soon as possible, dispose of, sell off these goods, which gives rise to the understanding that the stock is not supposed to build a long-term capacity for you. You're supposed to build short-term capacity, with the stock that you have. Now, when you purchase the goods, what is happening is you are paying for it. You are paying for it. So, purchase for goods, the account is called purchase account. Right? You are paying for it to the vendor. All right. Now, when you purchase, you have possession of the goods, and in return you are paying to the vendor. Now, we should note that purchase refers to the goods purchased which have been sold as well, which have been sold in a given year. All right. Now let me give you more details on that. This is a timeline. Let's say at the beginning of the year, which is April 2020, and this is March 2021. In the beginning of the year, let's say April and May. In May, you purchase 100 units. You purchase 100 units. The idea is that you're going to sell them. Let's say you are a trader. You purchase things and then you sell them further. So these 100 units are available to you for selling. And let's say 10 rupees is the cost price per unit of this good. So 1,000 is the money that you have spent. So right now, your expense, your total cost is 1,000, and let's say you have paid all of this. It turns out at the end of the year, that you were able to sell only 90 units, right? So you were able to sell only 90 units and 10 units are remaining in the stock. So the expenses for the current year should only be counted, should only be equal to the units which have been sold. So in this case, and I'm assuming no profit, no loss, for example, at this time. So so you have 900. If 10 rupee is the cost, 900 is the actual expense during this year. So at the end of the year, when you are preparing your financial statements, you are going to show only 900 as the expense. Remaining 10 units, what happens to them? Remaining 10 units, so rupees 100 worth of goods, this is going to be unsold stock. This is unsold stock. So this part becomes an asset. We know what is unsold stock, and this part becomes the expense because it has helped you generate revenue in the current period. So whatever is going to help you generate revenue in the next 1 year, you classify that as a current asset. But if something has already helped you generate revenue in this financial year, you have to match the cost of it to the revenue that is generated using this item. So expense is 900. So in all, effectively what I wanted to explain was purchase is an expense item. However, it is possible that all of the goods that you purchase may not be sold during the year. So only the cost of the goods which are sold. So again, another nomenclature, cost of goods which are sold. This is also called COGS or COGS in short. Purchase account has the cost of goods sold. There can be other things which could be added to it, but purchase forms a part of the cost of the goods which are sold during the year. Okay, let me wrap it up. It is an expense and all expenses are nominal account. Nominal account. Okay, let's move forward. Now you have sale of goods. Sale of goods is goods that you had purchased, now you have sold. So if I go back to the previous discussion, you sold 90 units. Now let's assume that 90 units out of 100 units were sold and you're selling them at a profit. So let's say 90 units times 20. So you made this much money. This is the income that you generate during this financial year. So the sale of goods is an income. You represent it by a sale account or sales account. All the goods that are sold are included here. So remember from the previous slide, you had bought 100 units in the beginning, right? And then at the end of the year, you sold 90 units, okay? And 10 units are unsold. What are we doing now? We are saying the sale of 90 units at 20 per unit is equal to 1800. This is my income. And the purchase of 90 units at 10 equal 900. This was my expense, and the 10 units unsold. 10 units into 10, 100 is my stock. So you see how these things are, how we are arriving at these three accounts. So sale account is going to show 1800, purchase account is going to show 900, and unsold stock is going to, let me write stock here, it is going to show 100 as a balance in this account. So for the purpose of sale account, which is an income, we're going to call it a nominal account. Nominal account, because sale refers to income. Okay. Then you have carriage on purchase. A couple of slides back, when we were talking about purchase of goods, I mentioned that there is a concept of cost of goods which are sold, and I said purchase is one component of it. There can be other expenses that you have to spend in order to purchase goods and then bring them to your place and get them. If these are raw material, then you have to convert them into finished products. So everything that, all the expenses that go into getting the product ready to be sold are clubbed into the cost of goods sold, and carriage on purchase is another item under that. These things will clarify themselves as we move forward. We'll have more elaborate discussion on cost of goods sold in one of the following videos. Carriage on purchase, let me define carriage. Carriage is equal to transportation, transport expenses or cost. Okay, so clearly it's a cost. You are transporting goods that you purchase to your godown or to your factory or to retail outlets. It's clearly an expense. An expense item. All expenses are nominal account. There you go. Then you have duty on purchase. What is duty? There are different kinds of duties that are charged in India. Duty refers to basically taxes as we understand them in the common parlance. There is typically an excise duty which is charged on anything which is produced, manufactured on Indian land. So excise duty means if you are if you are manufacturing goods, then you have to pay certain percentage depending upon what kind of goods you are manufacturing. There is a certain percentage that is charged by the government on it. So excise duty. There could be customs duty. Now, instead of manufacturing things here, you are importing it from other countries. When you import those, then you have to pay customs duty. Again, that can be clubbed under duty. There can be many other duties which could be local to the region where you're working or specific to the industry that you're talking about. But let me just broadly say these are the two kinds of duties generally which we are aware of. So clearly this is a tax, this is an expense that you have to pay on whatever you purchase, a certain percentage. So since this is an expense and we know that all expenses are a nominal account. There you go. Okay, motor van. Motor van, our vehicle basically. So motor van account. It is going to help you generate or create capacity. And when I say capacity, I defined this earlier as well. Ability to generate revenue. Ability to generate revenue. How do you generate revenue? You run the operations efficiently, effectively. So motor van is not directly going to help you generate revenue, but it's going to help your staff move around, your sales staff move around, or maybe you use this van for transporting goods. So in that sense, it helps you in the operations of the business and hence generate revenue for you. And in the long run, it's going to be with you in the long run. So motor van is an asset, and also it's a tangible asset, something that you can see, but doesn't matter which type of asset it is, as long as this is an asset, it is going to be categorized as a real account. That's it. Next up is furniture. Furniture, again, similar to motor van, it has a longer life. It is going to help you build capacity, generate capacity for revenue generation for the long run. It is an asset. It is an asset, and it is going to be categorized into a real account. Now let me do one sort of thought experiment or one variation of it. Till now we have thought of furniture as an asset. Now what if you were in furniture trading businesses, let's say furniture trading corporation limited. This is your company. Your job or your business is to buy the furniture, and then you have your cost and you add some profit, and then you sell the furniture and you make a profit on it. All right. If this was your business, then purchase of furniture is going to be treated differently. When I say treated differently, you're going to think about the purchase of furniture as purchase of stock, because you want to sell it. So whenever we say stock of goods, we are referring to the goods which we want to resell. Now purchase of furniture would be purchase of stock of furniture which we want to resell here. Therefore, in this case, the furniture is not an asset. Sorry about that. Is not an asset. Furniture is considered a stock item here and not an asset. This is very important. If you were in any other business and you're buying furniture for office use, then you would consider that as an asset. Now within the furniture trading corporation, you buy furniture for office staff. All right. Now this furniture can be called an asset. You can call this furniture an asset, but it is entirely different from the previous category of furniture, where the purpose was resale, and here the purpose is not resale. The purpose is to build capacity in the business. And I keep on saying capacity, I'm referring to revenue generation. You're not going to resell it. It's going to help you run operations efficiently, effectively, and hence you call it an asset. So be mindful of that, of this distinction that you may need to make from time to time, from case to case. Next up is land. Land, clearly we know, is an immovable asset, a fixed asset, or a tangible asset. All assets are real account. Again, if you were in real estate business, the different pieces of lands that you own, you want to resell those, so you will consider that as a stock. But if you bought land to construct your office, a real estate office at the top of it, then you would call it an asset. So rather than going by the name of a particular account or a particular item, please understand what is the purpose behind purchase of that item. How is it going to contribute to the business? Is it an asset or is it a stock in trade for that specific type of business that we're talking about? Next up, you have salary to staff. Now we're going to call it salaries account. Salaries account. Salary to staff are paid on monthly basis for the services that they render to the business. Straightforward. This is an expense item because it helps you build capacity in the short run. You pay for salaries, you have access to the services of the people. So all expenses are nominal account. nominal account, salaries. Yeah, all right. Next up is interest on loans. Okay, this is interest on loans account. The interest is being paid, let's say, to the bank on a loan, on a bank loan that was, taken, sometimes back. So if you pay the interest, now by paying interest, what are you doing essentially is you are servicing the debt. When I say servicing the debt, I mean you have to pay rent on the loan that you have taken. So consider this. You take a building on rent. You take a building for office use and you pay a rent on it. All right. What is building? Building is essentially a resource. Okay. And another kind of resource would be that you take loan, you take money from the bank. You take building from a landlord and you take another resource called money from a landlord who is called bank, and you have to pay rent on it, but this rent has a specific name, which is interest. That's how we think about interest in accounting. So you are paying interest, you are servicing the debt, you are servicing the creditor, people who have given you a resource, you have to provide them a return. That is called servicing the debt. So interest being paid on loans, we have discussed this earlier. This is a finance cost or finance expense. This is shown separately in the income statement of a public company or a private company. There is a specific head called finance cost. You could go back to the statements of Reliance Industries Limited and you will see an item called finance cost. This includes all the interest expenses that are to be paid on the loans that the company has taken. Since this is an expense, and also we have discussed that this is a non-operating expense. This is not an operating expense. However, this is an expense, does not matter what kind of expense, and all expenses are nominal accounts. Okay. Then you have the loan that you've taken from the bank. Now there is a bank, let's say State Bank of India, and the business takes a loan. So there is a loan, let's say 100, a loan has been given. So when the loan has been given, effectively what the business gets is, I should say, cash here or the bank balance effectively. And in return, the business now owes to the bank and there is a liability which has been created worth the same amount, and this liability's name is bank loan. This is the transaction that is taking place. So this bank loan account, so loan from bank has, we could call it bank loan account. This bank loan represents the liability that the business has towards the State Bank of India. So the bank loan is a representative personal account. It represents an artificial person. Bank is an artificial person. Bank is a company in itself. It's an organization. It's an artificial legal person. It has its identity of its own. So loan from bank therefore is a liability, and all liabilities, as the rule says, are called personal accounts. Okay, so one more time, the personal accounts refer to any accounts that where you record the liabilities of business towards a real person, an artificial person, or a representative an item which is representative or represents the real persons or the artificial persons. In this case, bank loan represents the bank. It represents the liability that the business has towards the bank. Therefore, we categorize this as personal account. Next up, you have loss by theft. Clearly, the name itself says loss, and in the rule for nominal account, there is expense or loss, income or gain. Two are treated as synonym. However, there is a difference in what is loss and what is expense, and I will clarify that. So, loss typically is not equal to an expense. Loss is, non-recurring in nature. Sorry about that. Non-recurring in nature. What is non-recurring? Recurring means it repeats. It's a regular feature in your business. When we say non-recurring, I mean it's not in your control. Sometimes uncontrollable, and also this happens due to the external causes. So here, loss by theft, you didn't plan for it. Loss by fire, you didn't plan for it. Embezzlement of cash, you didn't plan for it, and these are not typical expenses of business, but you anyways lost cash in the process. So such items are called losses. So nominal account says all expenses and losses should be, so all expenses and losses are the nominal account. So loss by theft, number one, it is a loss. Second, it is a non-operating expense. Although it's not an expense, we'll say slash loss. It's a non-operating item in nature. It's not primary to the business. It's something which just happens sometimes in the business. Anyways, so it comes under the expense slash loss category, which is nominal account. Nominal account, which is what is more important. So any expenses or losses are going to be treated as a nominal account. Loss by fire, same. I'm not going to explain this. So this is nominal account. This is non-operating expense slash loss. Loss on sale of building. What is loss on sale of building? Now, sale of building. Now, building was purchased. You are a typical regular trading business, manufacturing business. You do not buy and sell buildings, first of all. You need to understand that. Therefore, the building that you have is an asset which you have. Now, you have sold the asset. Whenever you sell the asset, so this is sale of an asset, right? Whenever you sell an asset, this is not a primary activity of a business. So this is non-operating activity. This is not the revenue that you generate by selling the asset. That's you did not set up the business to earn that revenue. You bought assets to build capacity, to help run operations, to help buy and sell manufacture other goods and services that you wanted to, and then make money in that process. But if you start selling your assets, it is not going to count as an operating activity, number one. However, in the course of the business, you may have to sell an asset because of various reasons. The technology is obsolete. You have to buy new machinery. There is some, fault in the machinery that you have, an asset that you have, and you want to do that. Or maybe you are moving the place of business in this case. It's a building being sold. You're selling the building because you're moving your operations from this area. So whenever you do that, you purchased asset at some value. So asset was purchased at, let's say, 100 cost price, historical price. We have discussed this earlier in the cost principle of accounting, where we said all assets are shown at their historic value, at their cost value. So rupees 100 is for what you bought this asset, and then there is a depreciation that is charged, reduction in the value of this asset. Let's say 50 is the depreciation till date. It's been 5 years that you bought this building. Now you are selling it off. So 100 minus 50, 50 is the book value, current value in the books of accounts. The value of this building in the books of accounts is 50. And now you are selling it. So the sale value right now is 70. You are able to sell it at a higher price, or possibly you could sell it at 40. So if you're selling at 20, you make a profit of 20. And if you sell it at 40, you make a loss of 10 compared to this 50. So I just wanted to explain this transaction and dynamics around this type of transaction. The account that we are now talking about is the loss that you face when you sell the building here. So loss on sale of building account, since it is a loss, you clearly know this is going to go into nominal account, but more than that, we need to also understand the nature of this account. So this is a non-operating expense slash loss. This is not a primary activity of the business. In case of loss by fire, I said it was an unplanned externally caused event, something which you could not do anything about. In this case, you could decide to not sell the building, but you have to sell the building for some controllable causes possibly. But the point is that it's not a regular loss of the business, regular expense of the business. It's a one-time, once in a few years kind of thing. So it's a non-operating expense, and all expenses are nominal. So let me stop here, and there are some other items which we need to look at. I'll continue that in the next video.